Here in this video, we are going to be going over everything you need to know specifically on AMC stock. As you know, AMC has been in what looks like a bottoming process. You have been green now 2 days in a row. On Thursday, you were green by 7.79%, up 32 cents on the day. And on Friday, you were up 8 cents, about 1.81%. So you've rallied about 10% in 2 days. Now, it's a small amount, yes, because the stock has fallen a lot. Yes, you're correct. Does this mean a larger rally could be in store? Well, some good things and some bad things to talk about here in this video. Hit the like button as well as subscribe to the channel. Let me know what you think about this information down below in the comment section. Now, first and foremost, I've talked about this before, probably 1,000 times, and I'll talk about it again. The holy grail of good news of a catalyst that will cause AMC stock to rally is Adam Aron giving us a commitment that he will not be diluting shareholders anymore. That has not come yet. Adam Aron is remarkably quiet on his X account, which I presume where if we were going to get this announcement, that's where it would come from. Now, in theory, if it does not come from here, it will come from AMC earnings themselves, the earnings report. Maybe not that happens this time around. I think it looks a little bit more likely. Potentially, we will get some kind of announcement like that for Q3, Q4 to not see that commitment anymore. If Adam Aron and the team knows anything about business cycles or presidential election cycles, you tend to get most of the return during a presidential year. Actually, mid-year, summertime. Before a dip towards the election, and then a very parabolic rally after the election. It tends to happen almost every, it happens basically the same way every time, right? Every year. So I think that's pretty interesting. Now, we'll obviously need to see what happens. I think that is the holy grail of catalysts, but other catalysts as well could be AMC posting better than expected earnings. We can only speculate on what those earnings would look like. It's pretty hard to come to a definitive conclusion, but at this point, AMC stock, good news is trading at a very low valuation. The entire market cap of AMC is $1.13 billion. AMC is consistently reporting revenues higher than $1.13 billion. So on some of your simple valuation metrics, AMC stock is not that expensive anymore, right? So I think that's important to point out. That could lead to more upside here in the near term. Now, you still see, if you look at the average analyst price target for AMC, that's at $7.02. That is a return from here of 55.65%, even following some of the recent price target reductions that we have seen from Eric Wold, from of other analysts that cover AMC as well. So I think AMC is set up on a risk to reward basis positively. Now, if we get dilution, if Adam Aron and AMC announce dilution, that is obviously going to be a massive problem. Now, specifically with AMC, I think the reason why we have been bouncing here is because you were so oversold. You were the most oversold just recently in AMC's entire business history. AMC had an RSI of 17. Even during the Rona itself, you were not this oversold. Not even close to this oversold. And you were facing potential bankruptcy. Now that bankruptcy is no longer here, relatively speaking, AMC should be able to survive for a while. Big problem will be the debt coming due in 2026, but hopefully AMC can manage that okay. And as of right now, it looks like that is the base case scenario, as long as AMC stock price can get up, get into the teens, and then AMC can raise capital with the stock in the teens. That will be, good. That's ultimately what we need to see. Now, the bad news is we have Fed Jerome Powell coming on January 31st, in which he could be a little bit on the hawkish side. Good news is March 20th, we're no longer pricing in the first rate cut, so maybe the Fed does not have to be as hawkish as they otherwise would have been. And now the markets are only pricing in 5 rate cuts for 2024, which is more in line potentially with a soft landing and inflation coming down faster than expected, not as much in line with a weakening economy. And, we've went from pricing in 7 rate cuts to pricing in 5 rate cuts. In that time span, AMC has fallen. Yes, this has been a week or two process of unpricing in these 2 rate cuts for 2024. But in the last 2 days, AMC stock has started to rally. So I think you're set up in an optimal position, at least for Fed Jerome Powell now, a much better position than you were previously. One of the other problems that we're potentially going to have is big tech earnings. Big tech earnings will start next week with Tesla and Nvidia, and then really get going the week after that. The week of Fed Jerome Powell, January 31st, is on Wednesday. And then you'll have Thursday and Friday. Thursday is going to be a big day, the day following Powell. And that is when you will be getting, some larger earnings like Apple, Google, Amazon, Microsoft, those guys. Now, the markets are expecting, 11% EPS growth. So if you come in lower than that, that is going to be a big problem for our markets. And that could potentially set the markets up for a little bit of disappointment, considering the S&P 500 is now trading at all-time highs. Yeah, you hit an all-time high on Friday. And that is not exactly set up in a position to have low expectations for earnings. Let's say EPS comes in with a 5% growth rate. Well, that's just not going to be good enough. Now, on the other hand, there are potential other risk factors out there as well. Take a look at this. It says, let's look at this one first. Let's see. It says the reported use of ballistic missiles against U.S. forces at Al-Assad Air Base in western Iraq by who right now appears to have been Iranian-backed forces is a massive escalation and is likely seen by U.S. Central Command as crossing a red line, which we have many red lines these days. But this says leadership within the U.S. Central Command, as well as other defense officials, have reportedly been urging the White House to allow them to go gloves off in order to halt any further threat by the Houthi terrorist group in the western Yemen to commercial shipping in the Red Sea and Gulf of Aden. According to officials, several options have been presented to U.S. President Biden, which he has continually denied. These include a larger scale air campaign involving the Air Force over western Yemen to destroy any Houthi offensive capability, an amphibious operation against several ports, including Hodini in western Yemen, and even limited strikes on targets within Iran to send a message about further aid and support to the Houthis. Wow. If we were to see something along those lines, markets might not like that. All right. It seems like this whole area is a powder keg at this point. And if if it did turn into a boots on the ground like situation, or, attacking Iran in some capacity or another, I don't think that's going to be positive for our market. So that's something to be watching for as well, because you are hearing that, some people, like, I can't think of the specific position right now, but the one that oversees global supply chains, global supply routes for shipping around the world, he says this situation in the Red Sea is even worse than what you've seen during the Rona. Now, it's going to take a while for that to feed into prices like we've seen, the last time around, but hopefully he's wrong. Hopefully this is not going to be a big shock to the shipping market, and hopefully that ultimately is not a shock for inflation. Now, Fed Daily says early signs that the labor market could falter could also trigger policy adjustment. So if you start to see unemployment picking up, job openings continuing to crater, the labor market becoming weaker, that could mean the Fed is, getting ready to pivot, or could pivot off of that new information. Now, that would be very much good news for the markets. I think this statement alone is very good news for the markets, because it shows the Fed is taking an active role to make sure things do not get worse from here, or do not get too bad from here. The last thing you want, and the one thing the markets fear all the time, day in and day out, is the Fed going too far? Are they asleep at the wheel? Do they have a grip on what's going on in the economy? This shows a little bit more competence from Fed Daily, from the Fed itself. So that is definitely an encouraging sign nonetheless. Now, Chinese stocks, the Shanghai Composite Index fell below its 20-year trend line. Something is obviously wrong over in China. Take a look at this. It says, let's see. I don't see it. I might have lost it. But at the same time, the U.S. markets are hitting new all-time highs. Chinese stocks are hitting lows that they have not seen since 2009. Little bit of a problems going on over there in China McChina. Now, Carl Quintanilla from CNBC, you guys know who this is. He shares something Goldman Sachs said. Goldman Sachs says inflation news remains very favorable. The U.S. has led the way, and we now expect that core CPI inflation will average just 1.9% annualized over the 6 months through December. We expect the Fed to start cutting the Fed funds rate soon, probably in March. Now, that is no longer expected by the marketplace at this current moment in time. So what does that mean? Well, if the Fed does cut in March, it's not going to be a huge shocker, but it's just not expected from here. Seth Golden says S&P 500 just hit an all-time high for the first time in at least a year. Since 1956, SPX has been higher 12 months later with a median return of 13.5%. Only loss was 2001, and that was due to 9/11. So, pretty interesting. Now, this is as well, we should point out, about 510 days since the last all-time high, and that was on January 3rd of 2022. Now, this is on the higher end range of time it took to actually get to a new all-time high. You could see you're definitely on the higher end. Other times, 1956, 1968, about 820 days. 1973 was the highest between periods, and that was 1,898 days. So it definitely could be worse than what you're seeing right now. But positivity percent is about 93% of the time. You're higher 12 months later, and by 13.5%. So if that were to happen again for the broader SPY, that would mean some very big gains for AMC stock. And I do think, Magnificent Seven is not going to be hot all year like it has been so far to start this year. Once you get to the second half of this year, rates are coming down. Quantitative easing could potentially be starting by probably June, right? I think you're going to be in a position where you see a broader market catch up, where stocks like AMC start to catch up to the performance of the broader markets. And maybe some of your big tech names actually start to catch down and actually start to fall a little bit, meaning you may actually get, let's say, a 10% rally in the S&P. Maybe the S&P goes to 5,200 by the end of this year, but maybe you do ultimately see a 50 or 60% rally in small cap stocks. And that is what Tom Lee is currently expecting from the IWM, from your small cap names. And that, as long as AMC plays its cards right, could send AMC stock potentially 10x higher from here. That could send AMC stock to $50 per share, $45 per share. Pretty easily, in my personal opinion. So we'll have to wait and see what ultimately does happen. Let me know down below in the comment section what you think about this information. Thank you for watching. I will see you in the next one.